We're seeing another day of bad news is actually bad news. In my opinion, this is good news. This is another step in the return to normal. We want to see this. We want a market that's well priced, accurately priced, fairly priced, provides investors with opportunities to generate returns and not get ripped off. Because I feel like the market we've had for the last couple years or so, in many instances, has been a market in which investors have been getting ripped off and not had much potential to generate a return. It should be that stocks are, fairly priced, not screaming undervalue buys, but priced in a way that they're providing the company with an accurate valuation that allows them to go into the capital markets and raise capital, but also provides investors an opportunity to get a return over time. What's happened recently is that the future growth of the company has been so aggressively pulled forward that we haven't been able to generate returns. And part of that has been due to the aggressive stimulus, which has made its way into the market, to the unusually low interest rates, which means that there's no return essentially for lending money, which is a crucial part of the economy. And if you're going to lend money, you should get a return on that. So I say again, bad news is bad news. One step closer to getting to that more fair environment. I'm not saying that, valuations need to go to nothing. They need to be ridiculous on the downside, but it's a good step towards getting back to that more healthy climate and healthy environment. So one step at a time, we're seeing what happens. But in my opinion, this is good news. What is interesting today is that tech is leading us on the downside. Now, that kind of makes sense on valuation alone. We've seen the massive run up. These stocks are very stretched. At least some of them are very stretched. They've had phenomenal years so far, tremendous years. Probably some of the best years in history so far. And there's, not a surprise that might start to give back just on the run they've had so far. But what I find is particularly interesting is that we're seeing tech lead to the downside as we're seeing a massive decline in yields. And I think this could accelerate and continue if yields begin to tick back up. And that all facts, all forces indicate toward that. There are people trying to be savvy, trying to get in ahead of the game, trying to be a hero, trying to be a little too cute, saying that, the Fed is going to cut, they're going to, pivot, all these kinds of things. And that just doesn't seem to be the case. Those people, in my opinion, are speculating. Speculating can make sense at times, but right now we're really just sticking to the facts, what's right in front of us, what makes the most sense. And those people that have been calling for that pivot, calling for that cut, they've been doing so for many, many, many months right now. And they might win in the short term because they, kind of do the herd mentality type of thing. But they haven't won in the more medium term because that's not what's happening. What's happening is that the Fed is engaging in a disinflationary process of quantitative tightening. They are raising interest rates. They are shrinking the balance sheet. They are selling bond securities into the market, which should suck up some liquidity, essentially shred some money. And that is going to be the prevailing force. That's why the saying is, don't fight the Fed. They literally have their hands on the levers of power, on the levers of money, and you don't want to fight those forces. You didn't want to fight them on the way up, obviously, and you don't want to fight them on the way down. That was obvious. Past couple months has not been so obvious, but, as recently as yesterday and today, Loretta Mester talking about, and this is nothing new. It's not like she came out here and surprised us. She said essentially the same thing every single Fed member that has spoken since the FOMC has said, that we put out the dot plot. Those are our projections. We're going to be data dependent. Barring any sort of crazy unforeseen circumstance, we're not going to change from that. And the data is pointing them in that direction. People want to talk about headline CPI, but that's not the accurate indicator of inflation. Of all the indicators of inflation, that's probably the least accurate indicator of inflation. What's more accurate is core CPI and core PCE, which have made very little progress. Very little progress. They're both just slightly kind of trending down, as Bullard says, if you squint. And then he has thrown on an additional indicator, the Dallas Fed mean, and he says if you really, really squint, you might be able to maybe see some sort of decline on that. So the core of inflation, the central aspects of it that the Fed cares about the most, are not declining, and they need all that stuff to get back down to 2%. Kashkari last week explained the 2% target, and the Fed ideally wants price stability. So they, in theory, want zero inflation. But the problem with zero inflation, and this is what Kashkari said, is if you looked at, for example, 2016 to 2020, the Fed's inflation target was 2%. You actually had inflation below 2%. So if you make the target 0% and you undershoot that, you have a big problem because you don't want deflation. You want deflation in the rate of inflation. You want that rate to disinflation, it's called. You want disinflation, but you don't want deflation. You don't want prices to come down. That becomes a serious problem for people who are paying back debts and things like that. So 2% is the target. That is price stability. They are unequivocally committed to this goal. They are not going to pivot from this goal until it's achieved. By all metrics, by all data, we are far from achieving that goal. We will likely achieve that goal at some point in the next year, 2 years, 3 years. It will be achieved, but it's going to take time. We're going to have interest rates at a high level for some time. They're not going to continue to hike until we get to 2%. They're going to hike real rates up to a restrictive level that restricts the economy so that disinflation occurs, but not so that there's a Great Depression, which I think is a totally fair situation. You want to get inflation down. You don't want to squeeze the lower class like we are. They say inflation disproportionately impacts those least able to bear the burden. And over time, inflation will be reduced. This is a positive outcome. Inflation hasn't been good for companies. It's not good for anyone. I mean, I guess some companies, yes, it's benefiting, but they're having labor problems. They have problems. And we want a nice, stable environment where we can make investments, get returns on those investments, have our company's cash flow, have those cash flows in part trickle down to us, investors, and ultimately have a nice, harmonious economy that is able to grow at a healthy rate. We don't want to accelerate it too much because then we have too much volatility, and that's what we're seeing now. So bad news becoming bad news again, I think is a good thing. Much better than bad news being good news. I mean, think about that concept, right? Bad news being good news. All these people calling for rate cuts, they're saying, they're going to crash the economy. Well, those are the same people who benefit from bad news being good news. So whatever. We're making steps in the right direction, but the Fed has a lot of work to do. The economy is going to slow. They are comfortable with that. The economy is not always booming. That is a fact. It has boomed too hard. It was stimulated too hard. And now we need to bring supply and demand into balance and get back into a balanced picture. And that's going to involve some bumps in the road because we had such exuberance on the way up. That's just the way it is. Don't you want to get away from this extreme volatility in the economy? I certainly do. I think you probably do in the long term. We're going to get there. We had the boom. Now we're going to have a little bit of a slowdown, and then hopefully we'll finish in a much more stable environment where we can invest for the long term, be comfortable in our investments, and reap rewards over the long term. So this is all for the good, in my opinion, and we're making good steps, but there's still going to be more to go. We've obviously seen tremendous events and rates and tech stocks. Those will probably be unwound, and the market, the Fed funds market, is completely mispricing the Fed's outlook. But we're not over here, so that is our edge right now, and we're playing it. So that's today's video, and until next time, peace out.